Welcome to the Passive Mobile Home Park Investing Podcast with your host, Andrew Keel. This is the podcast where you can get the education you need to invest 100% passively in the highly profitable niche of mobile home parks.
Welcome to the Passive Mobile Home Park Investing Podcast. This is your host, Andrew Keel, and today we have an amazing guest in Mr. Ferd Niemann. Ferd is a mobile home park owner, operator, and lawyer, as well as a real estate investor, financial analyst, entrepreneur, and attorney whose career has focused on a myriad of areas of real estate. His experience includes mobile home park investments and turnarounds, retail development and redevelopment, residential investments, and real estate law. Before starting his own firm, the MHP Lawyer, Ferd practiced law at a top Kansas City firm focusing on economic development incentives, public finance, property tax assessments, redevelopment, land use, and zoning. Ferd, welcome to the show.
Thanks, Andrew. Appreciate it. Thanks for having me.
Yeah. We'll just jump right into some questions. Can you start out by just telling all of us a little about your background and how you got into the manufactured housing business?
Sure. So coming out of college, I had degrees in finance and accounting. I wasn't sure at the time if I wanted to get into law school or not at that time, so I pursued my MBA. And at the end of the MBA, I was like, well, I still kind of feel like sticking around Kansas City. Let me just punt law school for now. So I took a job at Jackson County as a commercial real estate analyst, and I looked at kind of complex real estate projects with tax incentives. And in the meantime, I was also doing single family, some flips, some buy and hold, residential investing. And then I just kind of thought, man, I'm making good returns on these projects, but it was really like a good percentage return. So say 30, 40%, but it was hard to scale. I thought, man, I'm making better return than these developers that are doing these big complex projects. What else can I look into? So I thought, well, let me start looking at properties and asset classes that have low expense ratios. And I kind of came up with, through my research, MHP and self-storage. Decided to go the MHP route, and they own a little bit of self-storage just as an appendage of MHP, but really went the MHP route, started doing that on the side. And then through Jackson County, I became director of economic development, then later the director of assessment, the county assessor. And then after that, so simultaneous to that, I ended up going to law school on a part-time basis, graduated law school, passed the bar, and then left Jackson County and went to a law firm here in Kansas City. Practiced law for several years, then when joined a firm client, did retail development and redevelopment for several years, all while doing MHP for about the last 6.5, 7 years now, kind of on the side, really been doing MHP, really full time the last few years. And it's been good. Obviously do the legal practice as well with an MHP focus. Don't really do any tax incentives anymore. Don't really do much as far as retail zoning or things like that. Really just kind of focus on MHP law and or MHP ops.
I love that. Thank you for that little background there. So in regards to your law firm, a lot of our listeners are passive investors that have, either done funds or syndications and other asset classes and are new to the mobile home park asset class. What would you say is the most important thing that passive investors need to look out for when investing in a mobile home park, say syndication?
Well, I think for any syndication, the most important thing would be look at the syndicator, and then do they have skin in the game? Do they have experience? What kind of track record do they have as far as accountability, transparency? But I mean, MHP specific, some of that's going to be, does your syndicator know what they're doing, especially in areas of like zoning? Because as the grandfather status is about all you can get in most MHPs. I mean, it's very rare you'll find a legal mobile home park that's legal conforming. So you want to get stuff that's legal non-conforming, and that would be grandfathered. So really making sure that the rights to purchase, own, and operate the park are there. But not most, but a lot of projects also have an infill component where you're going to bring in more homes, and that's really where the value add is in a mobile home park investment. And you need to make sure that you have the proper setbacks, the proper zoning, permitting to be able to do that. So if I was a limited partner investor in somebody's syndication, I would ask that question, say, hey, how are you going to legally bring in homes to implement the business plan? And if you're buying a stabilized asset, then that's less of a concern, but it'll be some concern still that if one of these homes moves out, burns down, blows away, how can you replace that lot so that you don't want to buy a stabilized deal that's already at its peak of all time. And the zoning is crucial to that.
Oh, I 100% agree. we have parks all the way from Minnesota to Georgia. And in one of our communities, actually in Nebraska, it is the hardest process in the world to bring a home in. Literally, the city inspector has to drive out and see the home, give his blessing on it. And then if he approves it, then you have to improve the home before it comes in, making sure all the smoke detectors are interlinked and not battery powered, and a handful of other things before you can bring a home into the community. And you can't rehab a home on the site because the city just doesn't allow it. You have to have the home move-in ready when it comes in. So we have communities like that. That's at one extreme end. And then you have the complete opposite side where it's like the wild, wild west. And,
right.
They just let you, you don't even need a licensed installer to install the thing. So it's just crazy how different it could be depending upon the municipality and the zoning. So
right. And with one thing there, I mean, I worked in government for 5 years, so I can tell you, it's good for the developer, or in this case, the mobile home park owner, to get along with the city or city county government. Yeah. At the same time, it may behoove you to push back. I bought a park here in Missouri, and the previous owner was trying to get a business license, which is $100. And it's pretty much a rubber stamp. And they had they called a pre-app meeting where public works, fire, water, police chief, planning, zoning, long-term planning, all these people are in the room, city management. And the fire chief said, I'm not going to approve your business license unless you put in 2 fire hydrants. And they had to run fire hydrants to run an 8-inch main throughout the park. I saw the invoice. It was $474,000. And the guys that sold me the park, they took a bath of I think they lost $1.3 million. And I went in to do the similar pre-app meeting, and I went to get my business license, and the fire chief said, I think I'd like to have another fire hydrant. And I said, show me in the code where you're allowed to impose that on me. He goes, well, it's not really it was more of a request.
Yeah.
And he was like, I got the last guys to give me some free stuff. I was like, they literally didn't push back and paid almost $500,000 when they could have hired an attorney or just looked it up themselves. And for $500 would have got that rubber stamp. So that was an extreme example, but I mean, it's amazing how onerous government can be, and in other instances, how friendly they can be. But in the MHP space, it's more often difficult than simple.
Yeah, 100% agree. The stigma sometimes gets the better of people, and they can't get past that. So I agree. It just depends on who you're dealing with. So how many communities do you currently own? Do you actively manage them? How has that process been for you? What are some of the hardest parts about the business in general that you see?
Well, the hardest part, I mean, it's going to depend on the community. So we have some communities that are stable, and those are going to be, say lower maintenance, and it's like a smaller park, say 16 or 18 lots. I've had several of those. And then we typically kind of say fix them and flip them. I have some that are buy and hold. But sometimes when we sell them, we'll manage them third party. So in the last year or two, I've sold 4 parks, and we still manage 3 of the 4. And that wasn't a requirement of the sale, but it made sense for the out-of-state investor that, hey, we can manage this, and so my team can operate them. So managing stabilized parks is not as challenging from a time perspective. I'd say the hardest part is definitely infill. And then I like to be regional. I'm in Missouri here. I mean, Missouri, we're under contract in Nebraska, Iowa, and Missouri now. And we have other Missouri and Iowa parks now. I'm looking at a portfolio in Georgia where I'm doing some work on as a lawyer, and then possibly going to end up, being part of the ownership team on that. So something like that, managing stuff from a long way away. If it stabilizes, not as challenging, but infill and just going through the CapEx changes at the beginning, and then really the first 6 months of ownership's hard. So what I've found, kind of what I learned in the retail business was, once you've got it stabilized, and when retail stabilized was really safe because it was safe, at least from a work perspective, because they were triple net leases. People will pay a premium for them. So my business partner had built, I don't remember how many square feet, several thousand square feet of triple net retail. And I was like, okay, now he can sit back, he can relax and just cash a big check. And he's like, no, I'm going to sell it. I was like, why are you selling it? Because now it's easy. I'll sell it to somebody else. They'll pay a premium. So it allowed him to have a lean team. So that's kind of the approach we've done. I've done some deals where I'm a limited. I have 5 or so deals where I'm a limited partner in. I've got several, a couple dozen where I'm a lawyer on. I've done some brokerage work on some. Generally active ownership flipping. I say flipping, renovating a handful at a time, and then some of those will keep forever. But I think I've sold. I think the last 2 or 3 I sold, and I thought I'd never sell them. So
Sure.
If the price is right, the workload's right, sometimes we sell. Obviously, there's tax consequences to that as well. But we do a blend. I think the hardest part to me is just the infill, because there's just so much work associated with, especially here in a state that's a HUD state, and then getting through the sales process. I'm looking at one part now where there's like drug issues and private sewer. And so that'll have a different set of issues where you have bad tenants or bad infrastructure. But those are that's not in every park, where I feel like there's infill in every park that's got value add.
Totally. Yeah. No, I agree with you there. And how do you manage that? Do you self-manage these? You have a team that helps you with that?
When I say self-manage, but obviously I'm not a one-man band. So my dad's my business partner, and then we've got several full-time employees, and then we got lots of independent contractors. Depends on the trade area. And some of them, 5 or 6 of them are probably full-time, meaning 40 hours a week or more, but they're on their own. They can take other jobs. They're independent. And then we've got lots of, third-party pros, like, the concrete guy, the install guy, things like that. And then in each park, we either have a park manager or a park greeter. And that could be somebody as low as $75 a month for very basic services like posting notices, to I've got a manager making, $45,000 a year. So anywhere in the spectrum. And then, I'm under contract in another park in the same trade area right now, where I would just basically reassign the manager. Instead of 5 days, 1-0-5-0, it'll be 3-2 or 4-1, and then go from there. But and then we've got back office that does the bookkeeping, and we use Rent Manager for our bookkeeping and our investor reporting and stuff like that. But we don't hire a third party. I mean, my company takes the management fees, if you will, and then we oversee. My dad or myself really oversee everybody on the payroll.
Gotcha. Very cool. Thank you for sharing that. Yeah. So one thing about Missouri is that, like you said, with the new homes, it's very elaborate. It's a HUD state. Site prep is very important. Making sure the piers and stuff are the proper depth. But then the used home process is like, not much regulation at all, right? I mean, it's unbelievable. So do you guys prefer one or the other? Have you infilled more used homes or new, or how does that work for you guys?
Yeah, I mean, 3 or 4 years ago, I would say, man, we really were looking for used because it's so much cheaper. I mean, obviously a used home is going to be less expensive, but also because of the HUD state, you're talking about $13,000 in add-on between concrete install, skirting, deck, steps, HVAC. On a used home that's already got HVAC, if it comes with some steps or something, you're talking, and that $13,000 does not include freight from the factory on a new home, but on a used home, you're probably talking $2,000 for all that stuff, and less, on the same level of concrete piers and everything like that. So I did prefer used homes, but practically it depends on the park. Yeah. It's like I'm under contract on one in Des Moines. It's Iowa, obviously, but it's got 3 empty lots. So I'll just probably look for a used home. I only need 3. I've got another one here in Kansas City Metro. I'm under contract on that I have like 11 empty lots. I'll probably do a combination of new and used. But I had another one here in Missouri where I had 50 vacant lots. And I was like, I'm not going to be able to find 50 used homes easily. Yeah. And I wanted to get them all. I had a 4-year business plan to fill that. It's been about 2.5 years and we're full. So when we've got them ordered, we'll be full here February 1st when they come in. So I could not have produced 50 used homes very easily. And then you need a full-time maintenance crew to get them updated and all that stuff. So I've become more of a believer in the new home just because of the brain damage that goes into finding and renovating used homes. But it's definitely more expensive, and I don't like the HUD regulations anymore than the next guy. But it is what it is.
Yeah, it is what it is. Totally. What does the perfect park look like for you? What's your kind of buying criteria? What is it? Where is it located? What is the typical acquisition?
I mean, probably not that dissimilar from you or other people. I mean, obviously, strong metro, diverse economy, lots of different, government jobs, prison jobs, education jobs, healthcare jobs. Ideally over 100 lots, but those are pretty challenging to find at reasonable prices. Ideally, public infrastructure, but realistically, I typically buy stuff that's kind of bruised and broken, so it'll have anywhere from 20 to 50% occupancy, and really not be bankable for most people. So then I buy it with a local bank loan, which is a recourse loan, that's not ideal, but it's ideal in the sense that a lot of people don't mess with it or can't get it financed because they don't have ties to the communities. Where I've got some banks that will go and kind of a 2 or 3 or 4 state footprint with me. So that's been helpful. and then if it has ideally big lots. I mean, if I can get, I did infill at a park in Illinois that we sold this year, but the lots only allowed 60, 65-foot homes. Well, that limits, your business plan. At another park where the lots are like anywhere from 76 to 80 feet. So I can put lots of 76-foot homes in, and that 76-foot 3-bedroom just sells so much better than a 2-bedroom. So that's the ideal, it's big lots. I don't like lagoons. I've owned lagoon. I'm under contract on septic. I've owned septic. I'm under contract on a physical treatment plant, and I've not owned well. I've got some clients that have wells, so I'm a bit around them, but I personally don't own well. I'm open to it. I was under contract on one in Nebraska and just dropped the contract for other reasons. But so it's kind of the same ideals as a lot of other people, but I will tackle lower occupancy parks if they're within 5 or 6 hours of where we have a footprint.
What are your thoughts on park-owned homes?
I think park-owned homes is just part of the business. I mean, I tell people all the time, in my ideal world, I own 0 homes, but practically, then maybe it's like, okay, in the ideal world, I own less than 100 homes. It's like, we're never going to get to 0. I don't think, because of the nature of bringing them in. So we bring them in, we rent some Section 8 even. We sold some through 21st mortgage. We sell some cash. Depending on the state and the regulations, there's options for selling them on a contract for deed or lease to own that can become hairier. But we have park-owned homes, prefer not to, but it's just, and really it's a financing thing. Like right now I've got 2 parks. I'm trying to trim that ratio down to below 20 to 25%. So I qualify for agency debt. So as part of the infill strategy, I just make sure, like sometimes I'll say I've got 5 houses for sale, 1's for rent. And once that one goes for rent, the rest are for sale. But then if I convert somebody, like I just closed on one today, where we converted somebody from a renter to an owner. So I told my manager, hey, you can go rent one more, and just trying to keep that ratio, in the teens, ideally. But sometimes we get to fill the houses. It's definitely easier to rent them. And I think you can do the park-owned home model. It's harder to scale, and you got to have a maintenance team. And if you only have 6 park-owned homes, you don't have a full-time maintenance guy. If you got 30, well, then you got enough work to keep the maintenance guy busy.
Totally agree with you. And one thing that you mentioned is, making your park bankable. I think that's something that's very important, and not enough people look at the end game first and say, hey, what are the agency lenders going to require? They're going to require that you have less than 20% park-owned homes, and they're going to have certain requirements for off-street parking, et cetera. So I like that you guys are looking at that up front. So do you raise capital from investors? Do you do syndications?
I do. The last 3 parks, we just with Dad and me. So I don't raise capital on every deal. Okay. I met with somebody this morning. I am going to raise capital on a couple deals I got going. It really just depends on the deal and the amount of capital needed, and then just the total deal plan and structure. But yeah, I have raised capital. Also done legal work on syndications for some other clients, and I'm under contract on at least one of them right now. I will raise capital on, and I've got another one actually I made an offer on last night that is a pretty big project that I would definitely raise capital on. So I do it some, but I'm not.
Not every single.
It's not every deal, and just there's lots of different deal structures, and I don't know. I just don't always do it, but I will, and I will in 2020. I will in 2021. In 2019, I don't think I did. I think I just bought 2 or 3, and just me and Dad in 2019.
Very cool. And how do you normally set those up if you are raising capital? What type of structure do you offer?
Well, the structure, I've looked at 2 different structures. Really, the main one in the industry, I think, is the preferred return and waterfall method. So, for example, say, if I'm the promoter, I get, typically say 35% of the deal. I get 35% as a general partner. The investors get 65%, and the investors get an 8% preferred return, which means they get the first 8% of money before I get anything. And after they get 8%, we split the income or the profits 35-65, and you can split that up. I typically say that's the hurdle to split, whether it's operating cash flow, whether it's refinance cash flow, whether it's disposition cash flow. Sometimes, like on one deal, I took a big acquisition fee, and then I take management fees of 5%. But I took on the deal I got going, I'm going to take a much higher split than 35%. I think I'm going to probably take 75 because it's still going to be good enough. It's a really good deal, be good enough for the investors. And then I'm not going to take any acquisition fees. I'm not going to take any asset management fees. And that's just a personal preference at this point, just based on income. I don't need the acquisition fee to pay the bills. I'm going to get taxed on that as ordinary income. So if I instead take zero fees and take a higher piece of the promote, the general partnership split, in the long run, it'll be better for me from a tax position. And also, I feel like it's easier to raise capital when I tell investors, look, I'm signing the note, so I'm in the deal. I'm putting in my own cash, and I'm not taking any commissions. So that's how I've structured in different ways in the past, but I don't have 50 syndications or anything like that where I've looked at 50 different models, but I have been around and seen the numerous hurdles of 8 to 10% is this percentage, 10 to 15 is this percentage for the GP. I have not done that multi-tier structure though.
Gotcha. I know you said you signed recourse on the debt, and your investors, I'm assuming they don't have to,
right.
But do you also put your own money into every deal that you raise money for?
I have. On one deal I didn't. One deal I didn't put any money in, but I signed the note. But yeah, typically I put in money, but it depends on the deal. I mean, like I said, the last few deals I've put in just my own, so I didn't syndicate. On the current structure with my lender, they want me to put in, I don't say a token amount, but say 50,000 per deal, and then I can raise the rest. If I buy the deal myself, let's say it's $1 million deal. If I put in 200,000 myself, I don't need any partners. I can get an 80% loan. But if I syndicate, they want to give me a 75% loan, which means I need 250. So in that example, I'll say, okay, I'll put in 50. I'll sign the $750,000 note personally, and then I'll raise the other 200 from other people. And then there's obviously more raised for things like capital expenditures, reserves, initial operating cash. But and the one that I'm working on now, I'm not actually taking a fee, so there's no acquisition fee built in. But that would typically be in the capital raise as well.
Totally. Yeah. No, I think investors just like it when you have skin in the game, and
Sure.
Whether that's from your acquisition fee or from cash you're actually contributing, I think that's huge. So what is the biggest win that you've had in the business? Can you give us a case study that was your best one to date?
Well, the one that's the best one to date it hasn't finished yet, but I got kind of lucky, combination of luck, skill, and the good Lord watching me. But there's a deal that I have like 70,000 in, and if I sold today, I'd make $1 million. So
wow.
In 10 months. So the IRR on that is almost incalculable. That was a combination of off-market deal. Broker had a pocket listing, brought it to me, bought it several $100,000 below market, fixed it up, did the kind of lipstick flip, didn't even increase rents at all. So it was one of those, like, they didn't need to push the rents. I would instead want to push occupancy. Did a better job of sub-metering the water, put in a nice playground, repaved the streets, put in some decor, put in driveways on every single house, including tenant-owned homes, and painted every single house, including tenant-owned homes.
Wow.
And took the occupancy from 24 out of 52 to we're now at 48 out of 52, and we'll probably be at 52 by the end of the year. We'll be full, and we bought it last December. And it was just Dad and me, and we got 100% loan. So put like 70K into the CapEx that I referenced, the minimal CapEx that I referenced. And it's just, the deal's been humming, and I'd say pretty close to 100% collections. I got a couple people late, but they always have paid. We had one person bail, and they immediately refilled the house. And it's been, so that's going to be from a percentage return. And then just really the amount of work I've had to put on that deal is somewhat minimal personally. So that's going to be, it's not $50 million or something, but that's a lot of money still. And it looks like it's going to pan out for me. So.
That's fantastic, man. Congratulations, dude. I love hearing that. And do you have like a project manager type employee that helps you with your, CapEx projects and infill and things like that?
Well, I mean, everybody in our team does operations. That part we just hired a good manager. So that was everything we got lucky on. A Hispanic manager. And I speak zero Spanish, and a lot of the tenants speak zero English, and this guy is just the best. So I'm not going to disclose where he's at because I don't want you to steal him. Because as soon as we sell this park, I've already offered him a full-time job. He has a job at a factory too and does this on the side. I'm going to say, you want to move? So I'm looking for parks within an hour or so where he lives, just because so he doesn't have to relocate. He likes living in this community. So from a project manager, my dad does a lot. I do a lot. We've got several other full-time employees. I just hired a CFA who's going to help me with the underwriting because I've been busy. I have too many deals to look at the financials and underwrite them, as well as the capital raise, and then to me to do the legal stuff and kind of team leadership. So more of the project management will go on this new guy who doesn't start until the 1st of December. But right now it's really just a lot of me and my dad and working too many hours, but it's so far so good.
That's fantastic, man. I love that. So what would you say is like your value proposition as an operator? What makes you different? What makes you stand out? I always say that our specialty is the infill process. That is, every operator you talk to, says that that's the toughest part of the business. Right. So we have our own transport company based out of St. Louis that has helped us kind of overcome that hurdle. But what makes you guys stand out and be different?
Well, I would say just kind of a team effort as far as work ethic and attitude, and we all kind of love what we're doing. I mean, for me, is my contribution as a lawyer, I think helps a lot. Where I say my biggest job duty is that I worry, and I worry about what could go wrong, and I worry about the worst case scenario, and I try to basically figure out the solution, and then if I look for problems that don't exist yet, kind of a pre-mortem, if you will, instead of the post-mortem exam. So that works. I mean, whether I'm looking at the 21st mortgage contracts or leases, waivers for insurance stuff, waivers for contractors, dealing with the city, getting zoning issues. I mean, I've been able to negotiate hard with several cities where other people couldn't, and I've been able to get favorable zoning letters, which has been the difference maker for us in some of these parks to be able to bring in the right size homes and the right amount of homes. So I'd say my legal knowledge helps. But overall, it's just, just really just stepping in the shoe, signing recourse notes. I mean, right now my recourse notes are down, but I mean, I was a year ago, I probably had over $10 million of recourse notes. So that makes you really watch your stuff really closely. I'm in the process of moving 3 parks onto non-recourse notes right now because they're now at that level of stabilization. But go to bed worrying, man, if this thing I had a tornado almost hit a park, like I would have lost $500,000 last night. It was 2 miles over. So that kind of stuff wakes you up and makes you pay attention. So I think that's kind of one of my value add is that I am pretty obsessive about trying to operate as perfectly as possible. Yeah,
that's huge. I like that. So what would you say has been like your biggest struggle or your one park that was like the dud? And what were the struggles within that one dud of a park? One park where we didn't do all the infill. We brought in 20 and we had 14 left. We just decided let's just move on and sell it. And we still manage that park for the current owner, but it was really just a kind of a rough and tumble town. Mm-hmm. We did I don't even remember, 15 park-owned home remodels, and and they were rough remodels, over $200,000 of cash into these deals, into these homes. And it was just a rough and tumble town where the contractors wouldn't show up to work. You'd get professional contractors, they'd give you a bid and they wouldn't show up again. They'd just walk. We went through dozens of professionals, quote professionals and handymen. So that was hard. And then the clientele in this park ended up having, there was guys, 6 or 7 guys that had the swastika flag flying and stuff, pit bulls running around, fights, drugs, sex offender was in the park, people sneaking in. So that park just was rough, man. And we cleaned it up, got rid of the bad apples, and then renovated a bunch of these homes. But then the quality of the clientele, they couldn't get bankable, couldn't get loans. So then it's like, we're going to sell these cash, we're going to rent these. It's hard to sell cash, so we ended up, we didn't want to buy the $20,000, $30,000 house. We wanted to buy the $6,000 house. Well, then you're going to get, at times, lower clientele there. It took a lot of licks, man. We ended up selling it, made good money on it, but we left money on the table for the next guy. And we really bought that one right. And we had to replace the gas lines, patch the redo the roads, trees, put in playground.
It was just
a lot of CapEx.
It was a lot of. We spent a lot of money in the park. It didn't make a penny until the day we sold it. I mean, it was just renovate. It never reached the stop in cash flow. It was okay. We didn't stop cash. It didn't start cash flowing until we stopped doing more renovations. So that one was just, a labor of love, but not really that much love. So that was it ended up working out. Good relationship with the buyer and everything too. We got out from the deal, but that was one that I just didn't want to hold it long term. So that was one that was intended to be a flip. Where a lot of people want to have it forever. I have some that I want to have forever, but I have a lot.
Where was that? Where was that located?
In central Illinois.
Okay.
Yeah, near Springfield.
Near Springfield?
South of Springfield. So Illinois, I'm from Illinois. Stereotypically in the industry, I'd say once you get south of Springfield, you're basically in the South. And it's a different environment. And, the lot rents, for example, were $122. This is within a half hour of Springfield. Springfield was $350. So the kind of clients that had 122 lot rents, when we want to do a rent increase, they're just like, we can't find $5. It's like, we just spent $100,000 improving this park. It's time for a rent increase. And they actually didn't give us they just didn't give us much grief, but to get the next person in there, they're like, the new lot rent for the new people was higher. We got to 180, we got to 200 within a year, on day 366, got to $200. But when you add in a home payment, people are like, that's almost $600. And I'm sitting like $600 that's affordable housing. But they wanted to have, $400.
Yeah.
All in, you pay for maintenance, all that stuff. So the clientele was tougher as you got into Southern Illinois. Yeah.
No, we have a park in Keokuk, Iowa.
Oh yeah.
Very, very similar market, and it is what it is. Some markets are more depressed, and you can't get as much. I think moving forward in our due diligence, something that we implemented is during our test ads, we look at and pursue, how much of a down payment they have. And that has been a big teller to, of the market and the people and the new buyers. So, but yeah, very, very similar experience. So Ferd, what is your end game goal? Where are you going to be at in 10, 20 years from now? Maybe retired on a beach or still,
I don't think I'll ever retire. I don't know what my end goal is. It's always changing. I've changed my career several times. I didn't think I'd be in the MHP space, even this long. I thought it would get bought up by all the big players and all the big REITs. And I was like, maybe I'll just fade off in the sunset and, coach T-ball or something. But right, over the next several years, I mean, the goal is to continue to acquire mobile home parks, really do more that I'll buy and hold, where I've been flipping them more the last 4 or 5 years, and then cherry pick. And I don't know if that number that I'm going to hold is going to be 10 or 20 or 50. I don't foresee myself getting to 100. But then also do some legal services for sure on some of the bigger operators as well and smaller operators. And I plan on staying in the business for a while, but I feel like at some point the fragment industry there's going to be 10 owners, 10 big companies, and I'm not going to be one of them. So we'll see. But that's kind of where I feel like it's going to go. And I don't want to be, working for some big REIT or something like, oh, hey, well, you run this portfolio and you can be regional manager of Missouri and Kansas and Iowa and Nebraska. I don't want a real job. I like working for myself. So
sure.
We'll see how that looks in the future.
Yeah, totally. Well, is there anything else that you would, like to add value to our listeners with, that you think they should know about the mobile home park industry as a whole?
The only thing I can think of is, I would recommend people, start slow, buy one park, buy 2 parks, and then actively manage them. I feel like I see a lot of guys now, some of them are clients, I won't say who, but they'll be like, I got 3 deals in their country, I'm closing on all 3 deals this month. I'm like, and none of them are within 10 hours of your house. It's like, you have no idea how much work this is going to be to infill all these. And there's some guys buying 10 parks in the first year and betting on pro forma cap rates or pro forma lot occupancy. And so I worry, right? So just be conservative in your business plan, at least out of the gate, because I've bought parks from guys that had the same business plan as me. They just didn't implement it, and they lost 7 figures. So it's on a single deal. So just measure twice, cut once, I guess is the value added advice I'd give.
Totally. Yeah. Experience is very important in this asset class. Executing projects, I agree. Well, thank you so much for coming on the show and adding value to our listeners. How can our listeners get a hold of you if they'd like to do so?
Well, my website is themobilehomeparklawyer.com. My podcast is the Mobile Home Park Lawyer Podcast. My emails, phone numbers are on there. It's Ferd, F-E-R-D, at themhplawyer.com.
Awesome. Well, that's it for today. Thank you all so much for tuning in.
Thanks, Andrew.
Hey, are you getting value out of this show? If so, would you mind please going over to iTunes and leaving the show a quick 5-star review? I have a goal of hitting over 100 5-star reviews by the end of 2021, and it would mean the absolute world to me if you could help contribute to that. Thanks ahead of time for making my day with your 5-star review of the show.